I just was making my case for the notion that we don't know how much the current increases in rates have been very steep and very quick.
Right.
Isn't it possible that there's going to be a pretty good effect from that, and we just don't know, and it'd be so easy to go another 75, and it'd be like, oh my God, we really didn't need to do that, which makes me think we should do 50. Why am I wrong? Tell me.
Well, first of all, the market says you're wrong, but only because the Fed is sort of telegraphing the market. So we're in this loop here.
I guess I just don't like the whole demand destruction idea.
I think there's an argument for the Fed to go slower. The problem from the Fed's perspective is that they just don't see the progress in the inflation numbers that allows them to come off of their rhetoric and the thrust of what they've been saying, which is that we need to get out in front of this. I think a 3% or what are we at 3.12 right now, whatever, between 3 and 3.25, is probably neutral right now. And I think the next move into restrictive makes sense. The question is how far they go. And I think that there's a point or a case to be made for a pause at some point to see what's been happening, especially when you start to layer in the systemic risk issues that are out there.
Julia, all that said, Saudi Arabia didn't help, did they?
No, I mean, the ongoing destruction of demand that's coming from commodity prices is going to be a challenge in an inflationary environment where those can pass through in second and third round effects. But also it's very challenging for the outlook for the consumer. Wages are high, but they are not keeping up with inflation. Ultimately, that should help the Fed do its job as consumer demand cools in response to the loss of purchasing power. That should add pressure, price sensitivity. I mean, what we saw in the pandemic is that consumers just lost all price sensitivity and were willing to pay whatever it took for a used car. We're looking for the return of that price sensitivity, consumers demanding deals and bargains and really putting some pressure on companies to pass through some of the relief that they've been seeing on the supply chain front through to the retail level. We haven't seen a lot of that yet. We've seen a little bit of that, but we need that to broaden out. And so it's a slow process. The labor market's still strong. Consumers still have money flowing in their pockets. It's just losing value. So ultimately, we do expect consumers to, go on buyer strikes and show more resistance to ever higher prices. But in an inflationary environment where we keep having these energy and food shocks, companies are trying to pass that through. And so it's a little bit of a tug of war right now.
You talk about commodities, obviously, Julia. I'm thinking rail strike, and then I read maybe there may be other workers that saw what their colleagues or coworkers were able to negotiate. They're going to come back and want similar things. Is this going to be something that's getting let out of the bag right now, and that is a persistent pressure on higher wages from I mean, unions don't represent much of the country anymore, but everybody's going to want to get paid more, I think.
I would characterize that, and I think that the Fed in the minutes yesterday characterized that as a risk and something they're very cognizant of. And one of the reasons they're erring on the side of going maybe too far, too fast, rather than calibrating carefully, is that we are in this inflationary environment, and the labor market, it's tricky. It is strong on the one hand. On the other hand, the labor share of GDP hasn't risen. And we are seeing real wages decline, so it's not strong enough yet to deliver that kind of gain for workers. But it is a risk, and it's a risk in an inflationary environment where people are attuned to inflation. It is a topic of conversation. You can go to your employer and say, "Look, you can see my commuting costs and my housing costs are going up." And it's a reasonable ask. So it's not something we've seen on a broad basis yet. Really, it's the lower wage workers that have had the most bargaining power, whereas middle and higher income workers' wage dynamics look very normal. But, it could broaden out, and that's a risk that has an eye on.